Welcome to our webcast covering Newcomers to Canada mortgages. First, I want to thank you for taking your valuable time out of your day to be with us. I hope that by the end of our webcast, you have some interesting takeaways and contact us at your convenience for more in-depth information. For those of you returning to our webcast series, welcome back. My name is Edward Marinescu, and before we begin the webcast, allow me to quickly introduce you to our experienced and professional management team of licensed mortgage brokers that focus on both residential and commercial mortgages on the A side, B side, and via private lending. From simple mortgage needs to complex purchasing and refinancing situations, we've helped clients achieve their property visions with our solutions and lender network. Firstly, we have Mr. Rador Votescu, the owner and principal broker of Mortgage Capital Investment, combined with Hisham Farid, Mitzkanteria, and Eddie Marinescu. You can learn more about each of us from our bios on the MCI website. MCI stands for Mortgage Capital Investment. We're classified as a medium-sized mortgage brokerage, which has around 35 registered mortgage agents, and you can read our positive reviews on Google. MCI is the official trade name of an established brokerage of 15 years called Centum Total Mortgage Services, located at 455 Kerr Street in Oakville, Ontario. Now that you know about us, we welcome you to connect with us and stay in touch. So let's tackle today's agenda. Why do we call them newcomers? Who classifies as a newcomer? We'll talk about newcomer status types, applicants' eligibility and ineligibility, newcomer program details, down payment and qualifying interest rate, credit score, rating, and history and the importance on working on it. And then we'll move on to case studies, understanding opportunity cost, and why work with us here at MCI. And then we'll take up some commonly asked questions. Alright, so why newcomers? Why do we call them newcomers? Who are the newcomers? Well, think about this. Immigration is a big influence on investments in Canada. On average, Canada targets to receive between 350 to 400,000 people from different parts of the world on a yearly basis. The majority of immigrants come for a better quality of life, and they find their jobs in cities and suburbs. This demand drives home prices further up. As a result, our population is increasing, and as the Canadian government keeps the immigration programs active, this aspect alone will increase the demand for property and their values in years to come, especially if housing supply struggles to keep up, as has been the case so far. The financial system and borrowing in Canada can be complex for newcomers. If we look at the two newcomer statuses, it will help us understand these different categories. First of all, we have permanent residents. A permanent resident is someone who has been given a permanent resident status by immigrating to Canada, but who is not a Canadian citizen. Permanent residents are citizens of other countries. And the second category is temporary work permit holders. A temporary resident is a foreign national who is legally authorized to enter Canada for temporary purposes, and in this case, for employment. So let's take up the first type of newcomer, the permanent resident. If you already hold a permanent resident status and have a strong credit score and credit history, then you may be able to qualify for a traditional mortgage. No special consideration or additional documents being required by the lenders because of the New to Canada program. However, if you do not meet all of the qualification criteria for a typical mortgage, then we may still be able to obtain a mortgage for you through our expanded lender network, though with a stricter requirements list as they're taking on a bit more risk. So let's take up the second type of newcomer status, the temporary work permit holder. If you're currently a temporary work permit holder, the deciding factor in your mortgage application submission is whether or not you have already applied for a permanent resident status. From a lender's perspective, they would not be able to provide a loan term commitment longer than an applicant's legal status and allowed residency within the country. If a mortgage applicant is residing in Canada only on a work permit without a permanent residency status application in process, then qualifying them would be more challenging. Along with standard required documents by the lender, they would be asking for the permanent residency application copy to justify the applicant's length of stay during the term. Next, we'd like to go through the applicant's eligibility and ineligibility for the newcomer program. There are three main categories that would be eligible. They are 1. Permanent resident status without credit history established in Canada generally takes around 2 years of one or more credit cards to establish credit history. 2. Permanent resident status with credit history established in Canada. And 3. Work permit holders who have declared tax in Canada and are pending permanent residence application approval with PR Form 1442 as evidence. On the other hand, applicants are considered ineligible if they are individuals with diplomatic immunity, diplomats, or other foreign political appointed individuals not paying tax in Canada, or business for self-applicants for non-permanent residents. Please note, we ensure our applicants are kept informed as lender policies and requirements change over time. And now that you've created an idea of who would qualify for this program, let's take a look at the program details before we move on to pertinent examples. Please note there's a 2 properties maximum ownership limit, with one being owner occupied and the maximum property value being $1 shy of $1 million. The type of mortgage you would qualify for and what documentation would be required depends on multiple factors, such as whether or not you're already permanent resident, whether or not you have permanent residency application in process, whether you have an established credit history in Canada, and whether you have accumulated the required down payment in your own accounts with a Canadian financial institution. And so, speaking of down payment, it also depends on the type of property the newcomer is seeking to purchase. LTV stands for loan to value, and generally 5% of the down payment must come from the borrower's own resources, meaning it cannot be borrowed or gifted. And so when LTV is 95%, the down payment of 5% must come from the applicant's own resources or from a corporate relocation program. When LTV is less than 95%, the down payment can be gifted by an immediate family member, as long as the initial 5% comes from the applicant's own resources. And when LTV is lower than 80%, the borrower could apply for rental or cottage as a second property, although this is case specific. And as for the qualifying rate, known as the stress test, all applicants must qualify using the greater of contract rate plus 2% or the minimum qualifying rate. It's currently sitting at 5.25%. To return to the aforementioned credit score and credit report, if one exists, then here are the certain requirements in place. For those who do not have an established credit score and credit report in Canada, then alternate sources of credit history are required to ensure the borrower will make consistent payments towards the mortgage. For example, a landlord reference letter highlighting rental payments being made on time and 12 months of other debts being paid, such as utility bills, internet bills, and/or phone bills. For those who do have an established credit score and credit report in Canada, then their score indicates what debt ratio percentages would apply for them. For those who do not know this yet, GDS stands for gross debt service and TDS stands for total debt service. Logically, the lower the debt, the lower the percentage of both ratios, which proves the applicant is able to manage their debt. Please note, applicants with an active credit score of 599 and under would not qualify for this program specifically, and it depends on a case-by-case basis. And please take a moment to inspect this table showing how credit score impacts the newcomer's applicant's eligibility. You can conclude from it that credit score is very important to lenders, generally and especially when it comes to newcomers. The permanent residents with high credit scores could qualify for a traditional application, implying less strict requirements. Now, another essential aspect of the New to Canada program is the applicant's stance in regards to being able to repay the mortgage. Having built a strong credit history helps with this, but even if you as an applicant have not established your credit history, there may still be an option for you within our Newcomer to Canada framework. We've encountered this scenario many times, and although it seems more demanding to gather documents from outside of Canada, the majority of our newcomer applicants are inclined to create a strategy to implement so that they can make their mortgage application process smoother with documents sourced from within Canada. The first step for newcomers to obtain a mortgage in Canada is to build their credit score, rating, and history. Creating a strong and healthy credit history is important for newcomer applicants to obtain a mortgage with only a 5% down payment instead of the 10%, as they are gaining employment history and building up their savings. Our applicants benefit from us having conversations with them, sometimes over the phone only, simply to help them on how to utilize credit to build their credit in order to reach the needed requirements to qualify for a property mortgage. I remember when I came to Canada and looked at the utilization of credit cards, loans, and lines of credit as if it was a foreign financial language. Because I didn't understand credit, I didn't use it till later in life. I could have accelerated my steps towards financial freedom if I would have only asked for advice. Newcomers generally do not have their family and friends here in Canada, and they're seeking to establish a lifelong relationship and a healthy support system. We're happy to be the professionals you can rely on with life-improving information. And if you're a realtor listening to this, you may as well do the same for your clients. And now I introduce to you Mr. Hisham Farid, the director of our commercial division, who will run you through the first foreign investor case. Over to you, Hisham.
Thank you, Eddie. Hello, everyone. My name is Hisham Farid, and I will be sharing with you our first case study for this webcast. We wanted to touch on our edge through the following example of how MCI assisted a newcomer's family. Their name has been changed to protect their privacy. Let's call them the Smiths. The Smiths had a permanent residency status 2 years in and an already established credit history, seeking to obtain funding for their first home in Canada. We were approached by one of our realtor partners who connected us with Mr. and Mrs. Smith, seeking to finance their new home in Glen Abbey, Oakville. Being in Canada for 2 years and with an established credit history in a very good standing of above 720 beacon score, they had saved 20% of the property value as down payment. However, when they decided to buy their own family home, they used only 5% down payment after speaking with us. To explain this further, we ran different scenarios by them and suggested an option that they could qualify with only 5% down payment and save 15% for the other potential lifestyle expenses. The family have been in the country for a couple of years and were due for a family vacation. And with the new home relocation, it was time for them to invest in a family car and ease their daily job commute. So it made more sense for them to better use their savings towards the other expenses and achieve more milestones settling into their Canadian lifestyle. We will be touching on this with sample figures in an upcoming slide. Allow me to go through the standard required documents for this program. In a nutshell, we obtained and confirmed 3 months of employment pay stubs. Lenders usually ask for 1 to 3 months of pay stubs. Our lender requested a letter of employment from each applicant proving they have passed their probation period with current employer. We confirmed the proof of 5% accumulated down payment through their bank statements and being in the applicant's account for a minimum of 90 days. We walked them through each step during the application process. The Smiths qualified and we obtained them the required funding for less interest rate than they had expected. And with that said, back to you, Eddie.
Thank you, Hisham. That was insightful. And so to move on to a different example, I am pleased to introduce Mitz Kandaria, our marketing director with MCI. Mitz, over to you.
Thank you, Eddie. Hello, everyone. My name is Mitz Kantaria, and I'll be sharing with you the second newcomer's case study for this webcast. In this example, our newcomer's name and some personal details have been changed for privacy purposes, so we'll refer to this applicant as Jane Doe. Jane was referred to us by her accountant. She was originally from Brighton in the UK and has been in Canada for 3 years under a work permit status, which was recently extended by her employer. Jane has fallen in love with both Canada and a Canadian man who she met while working here. As a result, she decided to settle here for good and so applied for her permanent residency. Jane was paying rent for a condo unit in Markham and felt that it was time to invest in her own property. Otherwise, she would be priced out of the market with the way house prices were rising. So we worked with Jane in advance of her placing any purchase offers on properties so that she knew exactly what she could afford and so that she could have all her paperwork ready in time to be able to move quickly if she needed to. This included showing funds in her account for a minimum of 90 days, so she had to transfer savings from her UK account to her Canadian account in advance. These savings amounted to 5% of the down payment of the property value she could afford. Her parents were willing to gift her up to 20% of the property value towards the down payment. However, in the end, she only accepted 5% from them to make a total of 10% down payment towards a recently renovated townhouse in Markham. We obtained the necessary documents as shown in this slide and helped her to obtain funding for her new home. Now I want to explain why we highlighted for Jane to use only a total of 7.2% of the property value for the down payment when she had access to 20% of the property value for her down payment by borrowing from her parents. Let's take a property valued at $900,000. Option 1 was to put a large down payment of 20% or $180,000 to keep the monthly mortgage repayments lower. However, this meant that a large chunk of her accessible funds would be tied into the mortgage, and she would lose flexibility to use those funds for other unexpected expenses, such as a new car, house furnishings, renovations, vacations, or even to help cover wedding or other unknown expenses, such as children's education in the future. There was also a risk of losing her job, and if her income stopped even for a short period, she would not have anything to fall back onto. We suggested a second option to Jane because mortgage interest rates were relatively low and property prices looked to be increasing. We called this her opportunity cost. With this second option, Jane needed only 7.2% down payment of $65,000, leaving a sum of $115,000 available for other unexpected expenses or future lump sum payments towards the house once she had a better idea of her lifestyle choices and had more job security. So, with an additional cost of $20 to $30 mortgage payments per month for a $20,000 insurance premium spread over the amortization of 25 years, option 2 still allowed her to keep $115,000 available for other lifestyle or unforeseen expenses. Jane could use this money to invest into, for example, stocks and bonds portfolio that provided a higher return than the additional insurance cost. So in summary, option 2 provides Jane with choice, time, and flexibility. Also note that accessing a mortgage backed by mortgage default insurance provides access to a slightly lower interest rate and waived administration fees. In Jane's case, she has opted for a lower down payment and has asked her parents to help her out with her upcoming wedding expenses instead. I want to point out that we simply open our applicants' eyes to their borrowing options, but do not provide investment advice. The final choice of the option they choose is up to them. And with that being said, back to you, Eddie.
Thank you, gentlemen, for the detailed explanation of why it's better to have money in your pocket than to pay down more than necessary for a property. And so there you have it, 2 examples to shine light on how we improve people's lives through finding them the ideal financing here at MCI. We are recognized in being able to manage complex situations and have experience in finding solutions to new immigrants to Canada and other investors alike. We have access to a range of private lenders willing to assist newcomers achieve their financial goals, and so we welcome you to contact us to obtain funds for your investment in your first owned home in Ontario. You will have a dedicated mortgage broker help you close on your investment, who will work with you 24 hours a day from start to close, focusing with you on your application. Usually, we aim to reply to any questions you have within 15 minutes of your inquiry. At MCI, we can help you in the process of getting the financing as quick, easy, and hassle-free as possible while keeping you updated with milestone achievements and progress. After reviewing your needs and unique situation, we will connect you with our lenders network so we can seek out the best and most suitable lender, providing a competitive quote for your financing of the investment property. We have access to a broad lenders network, which includes A lenders, B lenders, and most importantly, private lenders, to provide you with an end-to-end solution. Once the quote is received and reviewed by us, we will negotiate with the lender on your behalf to get the best possible mortgage terms, conditions, and the lowest rate. Mortgage terms and rates will vary based on the mortgage application and its complexity. Thank you for following. Please take note reading our disclaimer, and we'd appreciate your feedback on this webcast if you email us at info@mcinvest.ca. And if you would like us to cover other topics of interest to you, we'd gladly do so, as long as you'd let us know. And now we'd like to go through some common questions we've come across. Question 1. Would work permit holders who are pending PR application approval be required to pay tax on the purchase of property if they qualify for a mortgage? The answer to this is yes, as long as the work permit holder is not a permanent resident. A non-resident speculation tax must be paid. However, it's best to speak to your accountant for specific tax information. Question 2. If the applicant has an expired work permit but their PR application is in process and currently delayed, can they still apply? Well, generally, their mortgage application would be nullified by the inactive work permit as their status has changed. They would first have to renew their work permit and provide proof of permit alongside the PR application. In other words, you need the correct status to sustain a mortgage application. Question 3. What if the husband has PR and his wife is on a work permit for another year, no PR application pending? Well, we come across similar situations. For this scenario, the wife would be required to submit a PR application and extend her work permit long enough for her application to be approved. Only then can they apply for a mortgage together, otherwise she cannot be on title, and this is assuming that all other criteria has been met and documents are provided. Question 4. How long do PR applications take to get approved? Well, we wish we knew the answer to this to help you. Unfortunately, this is not in our control, and you'll need to contact Immigration Canada for specific case processing time. And that wraps up our webinar for today. Thank you again for joining us, and feel free to navigate our website to www.mcinvest.ca to explore our full array of services covering residential and commercial mortgages. We look forward to putting together new webcasts in due course, and if you have any topics of interest you would like us to cover, please reach out by sending us an email at info@mcinvest.ca. This is Edward Marinescu on behalf of Mortgage Capital Investment, MCI, saying thank you for making time for this webcast. We look forward to working with you. All the best now.